I'm Nick Grove at the Morningstar Investment Conference in Sydney, and I'm joined by David Ellis. David, where are you seeing some pockets of value in the Australian financial sector at the moment?
Yeah, thanks, Nick. First of all, the major banks. We're seeing good value there. They're currently trading between 10 to 20% discounts to our fair values. Very attractive dividend yields, on average about 6%. Grossed up, that's 9%. So very good dividend yields and reasonably sustainable dividends as well, which is very important. Looking across other sectors, the insurers are looking good. QBE in particular, IAG and Suncorp. And I know you didn't ask this, but the health insurers, Medibank and NIB, are expensive and are trading well above our fair values at the moment due to sort of recent price surge.
And in your presentation, David, you spoke about investors should consider more than just moat ratings when it comes to their portfolios. Why is that?
Well, the moat is just one part. I mean, it's a very important part of our analysis and the way we look at a stock. And of course, with the major banks, we've got wide moats on those, and so we expect those banks to generate returns well in excess of their cost of capital for 20 years at least. But looking at other factors, the balance sheet, the strength of the balance sheet is very, very important. Looking at the dividend growth, that's very important, particularly in this day and age with historically low interest rates. And a lot of investors are looking for sustainable dividend, as I was saying earlier. So we look at a range of factors: the balance sheet, the leverage, the gearing, as I said, the dividend growth, as well as just the moats and uncertainty ratings.
And David, what are some of the main headwinds that you think the Aussie banks are going to be facing in the short term?
Sure. Well, there's quite a few. And bad debts is probably the biggest one. The recent result reporting, we saw a big spike, a big increase in bad debts. But importantly, it was noted that they were a small number of large corporate exposures, primarily to the resource mining sectors, New Zealand dairy sectors. Overall credit quality is reasonably sound. But going forward, we expect higher bad debt. So that's one of the biggest headwinds. Other headwinds are funding costs. Funding costs are elevated. Competition's tough. So margins are under a little bit of pressure, but they're holding up reasonably well. And cost growth, of course. Operational efficiency is very important, and the banks are spending a lot of money on satisfying regulatory requirements. And on technology. New technology is expensive.
David, thanks for your time today.
It's a pleasure, Nick. Thank you.
I'm Nick Grove at the Morningstar Investment Conference for 2016.